So I came here in Canada in 2020. I started doing job in the brick as a sales executive, and in after 15 days, like everything is shut down on that time in March, and I got laid off.
What are the main things they should keep in mind, even thinking about getting a mortgage?
Income, right? The down payment. There are two kinds of income, like in Canada here. So if you have like more than 1 year, it's a very good thing for you, but at least 3 months also would help in the salaried income.
Okay.
So the down payment plays a very important role in the eligibility. I think the favorite is going on right now is variable.
Nobody exactly understands the difference between refinancing and preload.
I just want to say one thing. Don't be casual with your credit score.
Hello, I'm Chehek, your host from Zone.ca. Today we have a very special guest with us, Ricky Grover. He's a mortgage broker with A Better Way Mortgages and has helped over 200 clients to find their dream home. Ricky has been awarded as one of the top producers in past year and this year as well in his brokerage. And just in the last 11 months of this year, he has helped clients get over $50 million in funded mortgages. On a personal note, Ricky is a loving husband and a proud father of 2 boys. Ricky, we are really happy to have you here. Welcome to our podcast.
And thank you so much for having me here. It's my pleasure.
All right, Ricky. So before we get into any details, tell us a little bit about yourself. How did you get into mortgage industry? And what is your role in A Better Way Mortgage?
Okay, so I came here in Canada in 2020, in Feb 2020. And I bring the COVID also here. I started doing job in the brick and as a sales executive. And after 15 days, like everything is shut down on that time in March, and I got laid off. And on that time, I got an idea, like I have discussed the things like what to do now with my family, with my sister, that what to do now. So she knows that I'm good in numbers, and she said, yeah, you should go with the mortgage broker, because my sister is also mortgage broker, Sonali Sharma.
Okay.
She has been like in this industry from last more than 12 years.
Wow.
And she told me that, yeah, you can do good in this line. So as I have just registered myself in the BCFSA and start like studying about the course and everything. And just like within 3 to 4 months, I have completed my study, and I just took a license. And after that, I got a call again from Brick that if you want to rejoin. I was confused on that time that I should have joined like the Brick, or I should just go with as a mortgage broker. But on that time, because I was working as a skip the dishes also, because just to any like fixed income to home like side by side. And so I just like choose to rejoin this Brick, and I worked over there like for 1.5 years. It was a good journey on that time. And after the Brick in 2022, me and my family made a decision that okay, now we should go with this as a
full-time profession.
Yeah, as a full-time profession and in the mortgages, right? I just need to go step into the business, right? In March 2022, I just started like my own business as a full-time mortgage broker, because earlier I was part-time. I was like getting the deal, but I'm just giving it to my sister. But on that time, I just started like all my own, and she was my mentor on that time, and as my family also like is very supportive on that time, because whenever we are doing like with a fixed salary job, so it's very hard to just make a decision to just go 100% into the business.
Right.
It was very hard step for me.
It was a big decision.
Yeah, it was a very big decision for me. And so I just started, and after that I never looked back.
Yeah, and you're doing amazing.
Yeah, I think so.
All right. So now I would like to ask some technical questions about mortgage industry. Okay, that would be very easy for you. But for our audience, the first question I would like to ask you is, what are the main pillars for any borrowers who is looking to get a mortgage for themselves, and what are the main things they should keep in mind before even thinking about getting a mortgage?
Okay, so most important is income.
Okay.
So an income you can say, and after that you can say the down payment and credit score. Okay, so according to these 3 things are the most important factor, that how we can just calculate the income and with the liability, and how we can check the eligibility of the client.
Okay. So if you can explain all these factors in a little bit more detail so that our audience can understand it in a more better way.
Okay, so first of all, the like income, right? So in income, if there are two kinds of income, like in Canada here, is one is like for the business as a self-employed or incorporate, and
Okay.
another one is the person is salaried
Okay.
on hourly or fixed salary.
Okay.
So with the salary, if the person is employed for at least 3 months, okay, then I can just calculate accordingly that how, if it's a fixed salary, then I need to calculate according to that. If it's an hourly wage, then I need to calculate hourly, then I can just take an income. So if you have like more than 1 year, it's a very good thing for you, but at least 3 months also would help in the salaried.
Okay.
Okay,
So what, 3 months with same employer?
Yeah, at least, yeah.
Yeah.
Okay, and if the person is like self-employed or like incorporate, then I need to check like at least for the big banks especially, at least I need to check like 2 years taxable income.
Okay.
So you can say like T1 general. So the second pillar, as we talked like about, as the down payment.
Right.
Okay, so the down payment plays a very important role in the eligibility. Okay, if you have a good income, like big income, then you are good to go with the sometimes you're good to go with the minimum down payment also. And the minimum down payments work like this, as in Canada especially, for the first 500,000, it's going to be like 5% of the 500,000, and whatever the rest of the amount till 1.5 million, 10% of that amount.
Okay.
So you can add it up like both, and that's called the minimum
Minimum
down
down
payment criteria. In such cases, in some cases, we need like 20% down payment also. And if I talk about the down payment especially, then if it's sitting in your account from last 90 days, that's the best thing. Okay, for you. But if it's not, you can take as a gift from your immediate family member.
Okay.
And some lenders are good with the cousins also, if you can just take from the cousin.
Okay.
And if the money is sitting outside Canada, then that money should be here in Canada at least 30 days before completion date.
Oh, okay.
Okay, if somebody is buying like a new house.
Okay, so let's say, for an example, I have some money in my home country, so that should be in my Canadian bank account at least 30 days before the purchase the closing date.
Yes, it should be here.
Okay, yeah, that's a very helpful
even
insight.
if it's a gift, even it's coming from your own account, but the money should be here in Canada.
At least 30 days. Yeah. Okay, and the last part as well.
About the credit score.
Yeah.
Okay, so credit score is also plays important role in this. So we need at least 600 plus to work with the good lenders. If you want to just open with all the lenders, then I should say it should be 680 plus.
Okay.
And,
makes sense.
Yeah.
So you would recommend having 680. Minimum
680 plus
decent.
is a decent credit score. We can shop around for the client.
Okay, moving forward, if someone is a first time home buyer and he approaches you, so what is the information, or we can say the documents you would need from them? What kind of information you think they should share and open to you about?
If I'll talk about the salaried kind, I need to see the most recent pay stubs and the T4s he have or with the previous employers last 2 years, and the notice of assessments. Okay, and if I talk about the self-employed, then I need to see 2 years T1 general and notice of assessment.
Oh, okay. So and those are really heavy terms you're using.
Yes.
So explain what is T4 in terms of salaried and T1 general in terms of self-employed.
Usually employers provide the T4s in the 1 year span. Okay, T4 is the document which shows that how much you earned with one particular employer.
Okay.
During that year.
Okay, in just 1 year.
Yeah, in just 1 year. Okay, from January till end of December.
End of December. Okay.
So the employer provide to the employee, and they should have access on the C login also.
Okay.
For the T4s, and they can provide over there. And if I'll talk about the T1 general, everybody has a T1 general. Whosoever is filing the taxes.
Okay.
Everybody has a
Not
T1 general.
Not only the self-employed.
Not only the self-employed.
Okay.
Everybody has a T1 general who is filing the tax.
Okay.
And but for the self-employed, the T1 general is most important because we can see the business activities over there.
Okay.
We can see the how much taxable income they're showing annually. So we need to calculate 2 years average on that.
Okay. 2 years of T1
and
general.
T1 general, once you file the tax for the year, T1 general provided by the accountant.
Okay.
To the client, yeah.
Makes sense. And you also mentioned something about notice of assessment. What does that mean?
Notice of assessment also everybody which receive who is filing taxes. So notice of assessment is included all the things, all the benefits, that income is also added in that, and all T1 generals, whatever the client shows income, it's added on the notice of assessment.
Makes sense.
So that is also like it's an important document for CA.
Okay, that was really helpful. Thank you. Moving forward, so once a borrower or a home buyer has shared all the information and documents with you, because everybody has a curiosity to check what they can afford while buying a house, right? What budget they can go for at maximum. So how you can help people know that this is the maximum they can afford? What are the factors you look into, when you are evaluating the affordability?
So as we already discussed, like if the person is salaried, so I need to calculate according to the recent pay stubs and the last 2 years T4s, whatever it makes sense. Like if I can grab the most of the income of the client, I'll just calculate accordingly. And if the person is self-employed, then we have it's a totally different criteria. So I just need to take 2 years average of income they have just shown, like they take out the dividends, they're taking out the salary or paychecks for themselves. So I just need to take 2 years average for that.
Okay, and then you can let them know their
and here we have some lender B also, like who is very good with the self-employed, and so they are flexible with this. They don't want to look into the documents. Okay, they are open with this, like they just want to see the last 1 year business bank statement.
Okay,
and they can just calculate the income out accordingly. So they're very flexible, they're very good for them.
So that is a good option for people, those who are self-employed.
Those have a 20% down payment, and the lender A says no to them, so lender B is a perfect option for them. But that should be at least on 20%.
So you are mentioning a lot about B lenders and A lenders. So if you can just elaborate, what are exactly A lenders and B lenders and difference between these two kind of lenders?
Okay, so lender A always want to see the taxable income. Okay, and whatever the tax you're paying currently also on the pay stubs and everything. Okay, how much income you're saving, how much is gross and everything. But the lender B is totally different, especially for the self-employed and the incorporations whosoever is not declaring the much income for themselves.
Okay.
And so lender B is a very good option for them. So the bank don't need your last T1 generals, T4s, NOAs. They don't care about it. They just care about your business bank statements. They just want to look into your business bank statement and they just calculate accordingly and they will approve you accordingly.
And how good you're doing in your business, right?
And there are two difference between the big banks and with the lender B. As one, for example, if we take the current scenario, so the lender A's are very close to 4% and the lender B is giving 4.75. So this much is the difference right now.
Yeah.
Okay, and the lender B, just because of their flexibility, the lender B charge 1%. Most of the lender B charge
on top of that
1% of the loan amount.
Okay,
and one more thing, lender B need 20% down payment. They don't work on the insured files.
Okay, minimum 20%.
Minimum
is
20%.
Required by lender Bs. Okay. Moving forward, Ricky, let's talk about some incentive plans or any specific programs run by BC government or our federal government to help a person to buy their first home. So is there any kind of plans or rebates you can mention about?
Okay, especially for first-time home buyer, which I like the most, I love to explain to the clients, is the property transfer tax exemption.
Okay.
So which is up to $8,000.
Okay.
Okay. I will explain with the example. If the person is buying a house for $500,000 and then the property tax should be on that property is $8,000, which is totally exempt for the first time. Okay. But if that person is buying for example, $700,000 property value, the property tax should be on that property is $12,000.
Right.
But the $8,000 is going to exempt out of that. So they just need to pay $4,000 as a property transfer tax. And the cap for this is $835,000.
Oh, okay.
Okay. And the partial cap is the maximum $150,000.
So do people know about such schemes? Do they really get benefit from these
I
schemes?
always explain them during the meeting. Even if there is a first time home buyer meeting, I always explain this is the help you are receiving from the government. Which is exemption.
That's nice.
And another one I think I want to talk about is the GST rebate.
Okay.
So if the person is buying any brand new property, till 1 million, it's a 100% GST rebate, and till in between 1 million to 1.5 million, there is a partial rebate.
Okay.
Okay, so it worked like this. So there is a very clear difference between this. Like, I want to explain about this GST rebate and the exemption.
Okay.
This is not an exemption, it's a rebate. So how it works, one time bank have to add the GST out on the top of the property values.
Okay.
Okay, and they will work on that value accordingly
And give you the loan.
and give you the loan on that value. So once they have to add GST on the top of that. Once you be owner of the property, after then you need to apply for the rebate.
Okay. So it's a kind of a cashback scheme. You get a cashback.
Yeah, you can say that. Yeah.
Okay.
Then the process will start and they will get back that money.
So you mentioned that 100% cashback
till 1 million
and
property
partial
value, and partial till in between 1 million to 1.5 million.
And what if somebody is buying above 1.5 million? Then
there's no.
So you are, you have first time home buyers on daily basis, right? You have a lot of interaction with them. So what do you think is the common mistake every first time home buyer is making, or most of the first time home buyers are making, in terms of, it can be anything, in terms of their credit score or their payments? So what do you think is the common mistake everybody is making?
I just want to say one thing: don't be casual with your credit score.
Okay.
Sometimes the small things like hurt a lot with your credit, like your TELUS mobile bill, and the small things like sometimes you switch your address from one basement to another basement or something, like if it's a first time home buyer, and they put the request to just close that account.
Okay.
But for some reason it have not closed on that time, right? And the bill cycle is going on and we were not aware about it at that time, right?
Oh.
And after 1 year, you receive a call from the collection department. So your TELUS or whatever the Roger bill is collection now, and that ruins your credit a lot. Okay,
And
so
apart from these bills, what are the other factors that can harm your credit score?
Sometimes what the client does, sometimes they receive the lots of e-transfer with so many people's, so many friends or family.
Okay.
Then you can also go. So this is not good for the down payment. Bank never like this thing.
Transactions, basically.
Bank only like the transactions which came from your immediate family member only.
Okay.
Not with your friends or something. Okay, so
That can also harm your credit score?
No. It's not about credit score. Credit score is done. This is started talking about the credit bureau.
So my next question is related to, again, credit score. This is a very crucial topic. So if someone has a bruised credit score due to any missed payments or anything like that, so how can one work on their credit score to improve it? So
I would suggest in this thing is it start with the higher interest things. The credit card has the more, you can say 22% or to 25% interest on that monthly basis, right?
Okay.
So just start working on the credit card first. Just pay off the credit cards as much possible as you can. Set up the monthly payments with your income, or $500, $1,000, whatever the debt you have. You can just set up your calculation according to that, right? After then it come a line of credit. Okay, just start paying some part of the line of credit also. And third is whatever debt you have, car loan, or if you have any other personal loan, start paying that also. But especially with this line of credit and the credit card, I can say your utilization should exceed 35%.
35%.
Okay, just keep as low as 35% utilization of your credit card and line of credit.
And make your...
Which helps to boost your credit a lot.
And how much time should
you take? Can say if you start working like this, utilization less than 35%, in 3 or 4 months you will see the change. Yeah,
that would be
or
quick.
In a couple of months also. Yeah, sometime.
Great. Okay, so Ricky, the big question: what should one go for, fixed rate or the variable rate?
If I'll talk about the current scenario, I think the favorite is going on right now is variable.
Okay.
Which is if I can provide you today's favorite rate is 3.65. Okay, and in variable you can say if there is a insured file less than 20% down payment. Okay, but if I'll talk about the fixed, who is fixed interest rate cover level, they can just go with the 3.89 maximum.
Okay. But you would recommend going?
Yeah, because you know what, if somebody has 5 years variable term, and after 2 years, if he thinks that it's the right time to switch to the fixed interest rate. Most of the lenders, if you want to go with the same bank with the same pending terms, they can switch your mortgage to the fixed term, whatever they have on that time.
Okay.
Whatever you can say
Interest rate is going
interest
on.
rate is going on that time, they can just convert it into fixed without any penalty.
Okay, but they cannot do the vice versa. They cannot, if someone has fixed, they don't.
Fixed, they always like put a penalty on that.
Okay.
But not on the variable. From variable, if you want to just go for the fix, okay, whatever the rest of the term you left on your mortgage, then there is, with the same lender, there is no penalty on that one. Most of the lenders doesn't have this penalty.
Makes sense.
So that's why I always recommend just go with the variable right now these days.
Okay. So once the term is completed and you are up for renewal. So talking about renewal, if someone's term is ending, what should one do to prepare themselves for a renewal and how soon they should get prepared? Now let's talk about renewals. So when somebody's term is ending, how should one prepare for the upcoming renewal and how soon they should start preparing for their renewal?
Usually when renewal comes, the bank contact the client 3 or 4 months like before renewals.
Okay.
With the rate sheet, they offer the terms that what you can choose, like fixed or variable, 3 years, 5 years, whatever it is. And if you already have good terms, you never miss a payment, then the same bank will provide you the best rate, which is already lower than the market, than the other lenders.
Okay.
If you want to just renew without changing any term, everything like same, without changing your amortization, without changing your loan amount, as is, if you want to renew, then you could get the best rate with the same lender, wherever bank. You are. Yeah. Okay. But if you want to take out the equity, okay, and or for some other reason like you want to switch the bank, then it's an all new process.
Okay.
Then you need to give your all income documents again, and it's just like a new mortgage.
So is there any penalty involved as well when you switch from one lender to another?
If the term is ended, you should tell your lender that I'm trying to switch to other lender for some reason. Okay, I want to take out equity, you can't able to give me equity or something, whatever the reason is, so I'm switching the lender. That lender should be aware about it, and so you can just switch to the lender, but if the term is completed, there is no penalty on that one.
Okay.
Yeah.
Makes sense. What are the main things a borrower should compare out of rate, amortization, and payment flexibility?
Rate is the top thing out of these, and the person should go with the rate if he is eligible for 25 or 30 years amortization, and every bank is giving 30 years amortization right now, and some of the lender Bs are giving 35 also. And you can say, if I'll talk about the credit score, the credit score is also very important part. I already explained to you that it should be 680 at least on your score.
Okay. And payment flexibilities?
So the payment flexibility, all the banks have a payment flexibility, if they want to go with bi-weekly payments, monthly payments, weekly payments also, so they can go for that one. But I always recommend to my clients, they should go for the accelerated bi-weekly.
Okay, what is that?
Because accelerated bi-weekly, without knowingly, you always pay one monthly payment extra.
Okay.
Which helps you to reduce your amortization. So even this simple step can save you 4 to 5 years of amortization.
Okay. So that's a nice step.
Yeah. Just if you can just afford this, just go with the accelerated bi-weekly payment.
So when you say accelerated bi-weekly payment, what exactly does that mean?
So whatever is your monthly mortgage payment, the bank divided into two, a half of the monthly, but they are going to take in every 14 days.
Okay.
So you are paying that 26 bi-weekly payments out of the year, which is eventually, if you calculate, you ended up paying 1 month extra.
At the end of the year.
At the end of the year.
Makes sense. Yeah. Okay. So our next big topic would be refinancing. So firstly, everybody wants to understand what is the difference between refinancing and HELOC. So everybody talks about HELOC, but nobody exactly understands the difference between refinancing and HELOC. If you can help us understand that.
We'll go with the refinancing when the client want to take out the equity
Okay.
out of our house for some reason. Okay, for that refinancing, or if they're just searching for the good rate or something, right? So refinancing is just like a one mortgage on one like the house, you can say one house, one mortgage, and one monthly payment.
Okay.
And when the client want to go for the HELOC, they're not going to touch the first mortgage. They want to keep the mortgage as is. They just take the, you can say, home equity line of credit extra if there is equity on the house. Okay, so the banks can give them HELOC, and whatever they use out of that, so they are going to pay like the interest part of that amount only.
Okay, so it's like a line of credit?
It's kind of line of credit, but it's a secured line of credit, you can say.
Line of credit.
Yeah. We called it a full form of is home equity line of credit.
Yeah, as the name suggests.
as the name says.
So Ricky, these days people try to consolidate all kinds of their debts. So if you'd like to explain what kind of debts people usually have, and what is the benefit of consolidate one's debts?
Okay, so the debts I can say are like credit cards, car loan,
Okay.
personal loan, line of credits. Okay, if someone have these kind of debt and have a decent equity in their house,
Okay.
so they can do refinance, and they can take out the equity out of that and make one mortgage out, and on a decent rate, on a mortgage rate like close to 4%, and pay all their like credit cards and everything, like because the credit card has a 22 to 25% interest rate on credit card, and the line of credit have at least like you can say 8 to 10% interest rates, and the car loan also like it's touching 5 to 6%.
Right.
So the best interest rate is like the mortgage interest rate. So it's better to take like, and the amortization also like really good, 25 to 30 years they can go for.
Right.
So with the very minimum payments, like they can just pay off their debts and they enjoy the monthly payments.
Right. And they don't have to do multiple payments as well.
Yeah.
Everything can go into one
into
payment.
one like monthly payment.
With lower interest rates.
100%. Yeah.
That's
4%.
Yeah, that's a really nice tip. Okay, so we are moving towards the end of our podcast.
Okay.
So if you have to give just one piece of advice to any borrower, what would that be?
The biggest piece of advice which I can give to any borrower: don't goof up your credit score. Okay, so if you want to reach me out, you can just go to my website mortgagesbyricky.com, or just email me mortgagesbyricky@gmail.com, or you can call me directly on 604-354-2725.
Ricky, thank you so much for joining us today. If you found this episode helpful, share it with your friends and family members who might be dealing with same questions. You never know. All right. So that's it from us today. Ricky, thanks again. And to all our listeners, take care, and we'll see you soon in the next episode.
Thank you guys. Thank you so much. Thank you, Chahak.
Thank you, Ricky. Bye-bye.